Hey guys, this is Vic from Grasping the Market and welcome to our market briefing. The monthly chart continues developing as a break from the 4-month balance range that we had earlier in the year, with the key 3000 level tested at Wednesday's close. On the weekly chart, we have resumed the one-time frame move up after last week's pause, and now we've been one-time framing up for 5 weeks. Zooming a little bit into the daily chart, following the breakout from the key 2962 level, we had a short-term balancing up here in the form of an inside day earlier in the week, but that was followed by a breakout continuation on Wednesday. Wednesday was a very short session with a close around the 3000 level, and that breakout left a little gap there. Now, the info on all these 3 time frames suggests that further upside is very probable. However, as we will see in a second, the market profile information telegraphs that we need to be very cautious here. When we look at the market profile, Tuesday we had an inside session. As expected, we had a rotational day inside, validating the poor profile that we left at the beginning of the week. But then the Wednesday session, towards the close of that Tuesday session, we had a spike up that you see here in this M and N period. And like we said, always in this type of situations, the focus on the next session is to assess validation or continuation from that move, and that's exactly what we had on Wednesday. Wednesday session confirmed and validated that move, with a trend day effectively breaking out from this 2-day balance range. Now, and we also left a gap. The extreme caution on this particular market setting comes from the following data points, I believe. Number one, the breakout on Wednesday left a weak low. It looked inside the gap. It looked one tick inside the 2-day balance range, and that was the low for the day, that leaving a very weak structure there. Second, through the session, you can see that there was no backing and filling. I mean, the low of the previous period was never challenged by the following period. So there was no inventory rebalance through the session. Number 3, the buying seems to have been very, very emotional, judging by the 4 distributions that we left. So we have a very, very stretched out profile that cover from 2980 to 3000, so more than 20 handles. You left 4 distributions and you advanced all of that in almost a straight line in 5 periods, leaving 4 distributions. That's momentum buying and emotional buying. And the odds are good that you cannot go too much further without backing and balancing inventory. So remember that we continue carrying forward the weak structure above 2900, which is down here. Remember that we have a series of weak lows, and that's and the proximity to this key level, which is the FOMC low. All these data points giving weak structure and suggesting short-term money driving the market up, they are adding up, and they don't add up linearly, they add up exponentially. So the market can keep going, in fact, but the more and more information suggesting that the move up is not healthy, the more caution you should be, and actually that will increase the odds of having a correction sooner and sooner. So the immediate focus for tomorrow is assessing continuation of Wednesday's move with acceptance below 2981.75, which is below Wednesday's range, denoting change. Also remember that early in the morning at 7:30 Central, we have the non-farm payrolls, and in my opinion, the market is pushing up, and is pricing that the Fed at the end of the month will do what they're expecting to do, which is cut rates. And I think we need to be very careful with tomorrow's report, especially if we get a good number, because if we get a good number, that will make a very difficult decision for the Fed to cut rates, because how can they justify acting that way when the economy is showing good employment numbers and strong growth. So be very careful with heading into the non-farm payrolls tomorrow. As we always say, anything can happen because odds are just odds.